Hey guys, Joel Frank here, market analyst for YouTrading. In today's video, I'm going to be discussing how official US jobs data, or the NFP, non-farm payroll report, impacts global and US financial markets. So before, we had jobs data released today, Friday the 7th of October. Before we discuss today's report and the market reaction, let's just go through the sort of general rule of thumb with jobs data. That is, pretty much, if the US jobs market is performing stronger than expected, as in it's adding more jobs than expected, wage growth is higher than expected, measures of slack in the labour market, which means the unemployment rate, the participation rate, the underemployment rate, if those numbers are stronger than expected, which means in the case of the under and unemployment rate lower, and in the case of the participation rate higher than expected, then generally what you would see is markets reacting to that strong labour market data by boosting expectations for interest rate hikes and tightening from the Federal Reserve, which would generally, you would think, boost the US dollar, boost US yields, and depending on the situation, it would often weigh on US stocks and other risk assets like cryptocurrencies, and again, depending on the situation, could also weigh on gold as a result of the stronger dollar and higher yields. And obviously, the reverse situation is also true. If you have weak labour market data, that could dampen Fed tightening expectations, which could potentially, depending on the situation, boost stocks and other risk assets as a result of that pairing of Fed tightening bets, could boost gold, and it could potentially weigh on the dollar and weigh on US yields. So that's like the general, very simplified rule of thumb. So let's look at today's numbers and talk about the US economy in its current context. Okay, so the headline number, 263,000 jobs were added, a little bit more than expected. Now it is slowing. It was 315k last month, as in August, and in July. Can't remember what the July number was, but it was much higher. So that 3-month moving average is moving lower, but that's still a good number. 263,000 jobs added in 1 month. Like, if that was before the pandemic, that would be considered a very, very strong number. So what's going on here? What's the takeaway? Well, okay, the US labour market isn't in the ferocious health that we've seen earlier this year and last year. It is slowing, but it's still strong. And remember, in the US economy at the moment, we've got very, very high inflation, core inflation that looks particularly sticky at around 6%, and that has the Fed very, very worried, and the Fed's been raising interest rates aggressively in order to head off this inflation. And to be honest, what the Fed would want to see, if it's hoping to win its battle with inflation, is actually the labour market weakening more than this, because this robust continuation of the labour market means that, well, it's good for consumers basically who have jobs, who are potentially seeing their wages rise. I mean, look at this, wages going up at 5% year over year. That was a little bit less than expected, but still 5%, that's well above the Fed's 2% inflation target. So this is a labour market that is still quite inflationary, and which will be a concern for the Fed. Unemployment rate as well fell to 3.5%. Now that's mostly due to a drop in the participation rate, meaning less people in the labour force, as opposed to jobs being gained. You can see here it fell to 62.3% from 62.4%. And yeah, like I say, that wage growth, those wage growth figures still robust. So strong labour market figures, still inflationary, still a concern for the Fed. If the Fed's going to take its foot off the gas pedal, or the brakes, you should probably say, with the economy, with its interest rate tightening, it's going to need to see much weaker jobs figures than this. So what about the market reaction? Well, I've got 5-minute candlesticks here just so you can see like the immediate move. Unsurprisingly, we saw the dollar surge. Not a massive, well, it was actually quite a big move, to be fair. It went from 112 to like above 112.60. Pared back most of that now, but you'd expect that it's probably going to remain on the front foot and above pre-data levels. That was the dollar. US yields also ticked up as well. Stocks, or a CFD that tracks the S&P 500, lower. Gold, you can see kind of moving in tandem with the dollar, but lower. Stuff like Bitcoin, you know, risk assets, lower. Why has this happened? Well, let me just look here at the at expectations for where the Fed's interest rate is going to be. You can see that the terminal rate for next year, as in that's the rate where markets expect the interest rates in the US to peak, is now back at around 4.6%, and looks like it's gonna, that's in June next year, markets expecting a Fed interest rate of 4.6%. Earlier on this week, that was 4.4%, so that's quite a big jump, and it looks like we're going to challenge recent highs above 4.7% next June, which is what the market was expecting a couple of weeks ago. So yes, this US labour market report has boosted Fed tightening expectations, and you've seen this market reaction. Now let's just look at these, this hawkish market reaction, you could say. Let's just look at all these asset classes on longer term time horizons. That's how I generally like to do things, because you actually see the trends which are going on in the market. This is the Dixie, which has been rallying for, well, pretty much since middle of last year, and I've been talking about how I think this rally is going to continue, and these latest US jobs figures very much underline that view. In terms of stocks, I was thinking maybe if the data was a little bit softer, we could have gone a little bit higher, but I think any bullishness that we had earlier this week is pretty much petered out, and I think the next stop for stocks could quite easily be another test of these recent lows. Let's look at the calendar for next week quickly, because next week we've got some big reports coming up. CPI, this is the biggie at the moment. It's actually bigger than the jobs data. I did a video last Friday talking about how US inflation impacts US markets, so do check that out before we get to this CPI data next Thursday. But pretty much, if this is hot again like it was last month, then we're going to see these US equities moving lower and that Dixie moving higher, and we're probably going to be testing year-to-date extremes in both. But anyway, guys, hope you enjoyed the video, and I'll see you all in the next one.